Welcome into today's Retirement Strategy Showdown. This is our Invest with Benefits live webinar that we try to do at least every month, but I think we've been consistent with it about every month. And um, as I was kind of thinking through the topics and ideas, concepts, things that people I thought would be interested in, this topic came to mind. And so far we've had a really good response. So we're going to be talking about the Retirement Strategy Showdown, Roth IRAs versus high cash value life insurance. I'm Christian Allen, CEO of Money Insights. I've got Brendan McConnell with me. He's one of our longtime advisors that's out in the field working with people day to day. And so he brings a really unique perspective. Uh, so anyway, Brendan, how are you, man?
So good. Yeah, excited to be here, excited to have the conversation, Roth IRA versus life insurance. And I think what people will find is at the end of the day, I think they both work really well together. And so excited to have the conversation though and kind of show what the differences are and we can go from there.
Okay. I love it. So here's what I'm thinking. Well, actually, to kick things off, I think I do want to emphasize or re-emphasize the point you just made. This isn't actually to say, hey, there's a winner or a loser. I remember when I was young, my dad was a CPA, and I remember being in the car. I was driving from the bank. I was probably like 14 or something like that, and he's like, Christian, you make sure you use a Roth IRA. And so it always stuck in my head that there has to be something good about Roth IRAs. Well, it turns out there really is, right? Like in terms of tax positioning, there's probably not a better positioning opportunity for us than being able to just pay the tax today and never pay it again, right? Especially, when we kind of consider the economic state that we're in as a country, it becomes easy to see how future tax-free income becomes more and more valuable as time goes on. Okay, so that said, what I want to do first is I first want to just start off by talking a little bit about Roth IRAs. We're going to then shift over, talk a little bit about high cash value life insurance. And then we're going to kind of go through a matrix that we created to talk through some of the, pros and cons of each. And again, it's not necessarily to try to come up with a winner and a loser, although we are going to focus on where they typically fit best and when and with who. And then after that, we'll take questions. So, and by the way, as you're going, feel free to throw questions in the chat, push them in the question answer. We'll either get to them as we're going, as we're just talking through stuff, or we'll catch them on the back end. So either way, feel free to get your questions out there so you don't forget them. Okay, Brennan, did I miss anything? Oh, I did miss
100%.
something. I did miss something. I forgot. Okay, I also wanted to make sure that I shout out the our next Investment Insider Series webinar that's going to be on October 28th with Jeff Urbick. He's going to be talking about all things private credit, which is obviously a really, really hot button topic right now. So if private credit is something that you've been thinking about or you're wanting to learn more about or get involved with, then this next one will be a good learning opportunity. And again, that's on the 28th at 11 a.m. Mountain Time. We'll put a link in the chat to that IAS webinar. So again, anybody who's interested in that, feel free to jump in there. Okay, Brendan, let's do this. Why don't you kick us off and just talk a little bit about what a Roth IRA is? I know this is simple, but we're going to make sure that we don't take anything for granted. Let's talk about what it is and kind of where we typically use it, and then we'll switch over to high cash value life insurance.
Yeah, so at a high level, a Roth IRA is a individual retirement account. It's a qualified plan, and what that means is it has a lot of the same stipulations that a qualified plan would have, similar to a traditional IRA or like a 401k. And some of those things, again, keeping it fairly high level, with a Roth, you're going to have a penalty if you try to access the growth before 59 and a half. So that's one clear thing that, you always want to understand on a Roth. Something that is unique with a Roth IRA compared to other qualified plans is that there's no required minimum distributions. Coming back to it, the reason why a Roth IRA now a Roth IRA has contribution limits. So let's talk a little bit about why there are contribution limits on a Roth IRA. The reason is because you're putting after tax dollars in, and then it is growing tax free, and you can access the growth tax free. And so the reason why they have a cap on that is because the IRS obviously likes collecting taxes, and they want to make sure that super wealthy individuals don't have that opportunity to put in after tax dollars and then, are able to pull out tax free. So It's a great product for that reason. There's not a lot of products that offer the ability to put in after-tax dollars and then, pull out tax-free. And other than that, it's an investment account. So you can either have
Yeah.
it invested in index funds, S&P 500, or you might have it self-directed, and we can talk a little bit more about that as we go, but you can also self-direct how those funds are invested.
Okay, so that's a good overview. Basically, the Roth IRA is simply put a tax wrapper, right?
Yep.
It creates a tax wrapper that makes anything that's inside that grow on the specific way that Brennan mentioned. I pay taxes before I put it in. I never pay taxes again on the growth, right? That's the beauty of it. And again, when you think about where things are headed, it feels like the safer bet to assume that taxes are likely to go up rather than down as we continue to get older, right? So, okay. And we'll dive deeper into Roths as we go, right? There's a bunch of other stuff that we can talk about, right? There's backdoor Roths that high income earners oftentimes use to convert from a traditional, which creates opportunity to put higher amounts in and things like that. So there's some fairly sophisticated strategies that you can utilize around Roth IRAs that make it a powerful tool for a lot of people. So again, I just want to emphasize we love Roth IRAs. We think that if I'm going to put money in a qualified spot, that's the best place to put it. And then, of course, one of the other things that's really important to remember is that I do actually have access to money in Roth IRAs. That's one of the differences between traditional retirement account. So if I have my money in a 401k or a traditional IRA, I don't have access to any of my money without the 10% tax penalty or, doing some sort of early withdrawal like a 72T or something like that. But that's pretty restrictive. On this side, I have the ability to take the money that I've put in. So if you think about it this way, I've got $1 million Roth IRA and $700,000 of it is basis and 300,000 of it is growth. I actually do have access. I can pull that money out. Now, it's not the same as life insurance, like we're going to talk about. I can't pull the money out and put it back in. I lose the ability to put it back in once I've pulled it out, but I do have the ability to pull the money back out. So again, there's some similarities and there's some differences, and we just want to make sure that we understand kind of how they fit together and work. Okay, Brennan, let's switch gears for a minute and let's talk high cash value life insurance. And I always emphasize this. We're talking specifically high cash value life insurance. What does that mean? It just means that we're assuming that the policy has been designed, built for minimum cost, maximum cash, so that I can use that for investing and things like that. If I'm comparing a Roth IRA to regular life insurance that hasn't been designed that way, it's not even, we're totally talking about apples and oranges here. So in this way, we can actually create some similarity in terms of our comparison point, even though obviously they do have some differences and some important and critical differences. So Brennan, why don't you take a second now and give us a rundown on kind of the basics of high cash value life insurance and what we expect to get out of what we're creating. And again, with the focus on it being high cash value life insurance, none of this
Yeah, and that
traditional stuff.
yeah, that's the foundational piece is that it's high cash value life insurance. It's got to be designed correctly. Don't after watching this webinar, don't go roll the dice at some insurance agent down the street and say, "Hey, they talked about this whole life policy. It's got some similar benefits to a Roth IRA." It's just got to be designed correctly. That's so important. Now, assuming that things are designed correctly and that it is a high cash value policy, we get some similar benefits that we get with the Roth IRA. Mainly, the fact that we can put in after tax dollars, and then we can get or we can access our cash back out tax free. So, as far as putting money in and taking money out, the way we do that might be a little bit different and nuanced. However, at the end of the day, we're putting after tax dollars in and we're getting tax free money back out. And high cash value life insurance, the way that we talk about it at Money Insights, we're typically talking about this in a wealth building conversation. And the way that most of our clients are utilizing this is they're flowing money into the policy, building up cash reserves inside the policy, and then turning around. And this is unique, and this is something that's not available with a Roth IRA. You have the ability to take a loan against your cash value life insurance policy and use those dollars somewhere else, and you continue to get that compounding interest in the policy. So maybe backing it up a little bit, High cash value life insurance is a very specifically designed life insurance policy. We put after tax dollars in, we can access tax free money out. There's obviously a death benefit attached to the life insurance policy, right? That's going to be something that's different from the Roth IRA, but at a high level, you got to mention the death benefit. And there's a few other benefits like, long-term care benefits in the policy and things like that that you would typically see with a life insurance policy.
I think that's a great rundown. One point that I want to make, and we get this question a lot, so I'm going to hit it right up front. One of the things that is different, and maybe a weakness of life insurance in this case is that I'm getting the tax benefit inside my cash value. I am not getting that same tax benefit inside the investments that are outside of it, right? So in that way, we are talking about a different thing. In a Roth IRA, everything is happening inside that tax wrapper. In the life insurance side, I'm getting the benefits of growing tax free inside the policy, and then I'm taking the other kind of typical benefits that I get. I'm taking um, uh, I can't think, depreciation, bonus depreciation, those types of things to create the outside tax benefit. So again, just want to make sure that as we're thinking through this, we understand that kind of core key difference between the two. And of course, like you said, one of them has a massive death benefit that comes with it, the other one doesn't. And I think the next place we should go, Brennan, is just like dive into our matrix. And what I did is I have, I think, probably 12 or 13 categories, and we're just going to roll through these and we're going to talk about which one, not which one, but we're going to talk about how each one of these, options fit inside of the overall equation. So primary purpose. Okay. Roth IRA, long-term tax-free retirement savings vehicle. That it's pretty simple in what it's doing, right? At its core, it's typically, and I should also say this, while Brennan mentioned you can self-direct, most people just don't. And there's some challenges that come inside of the self-directing world as well. Uh, but what we typically see is that the money that goes into Roths for most people is market-based money, which again, absolutely has a place, but it's usually pretty simple, just like an IRA, just like my 401k, the difference being that I'm paying the taxes on the front end instead of paying the taxes on the back end. When we think about what we're doing specifically with high cash value life insurance, it's probably more of like a foundational asset that's touching multiple different assets, right? We're using it to invest, we're creating a death benefit, we've got some natural estate tax benefits and things like that. So it's maybe something that's more holistic in terms of from a planning perspective. That's kind of the way I think about that. Brendan, you already hit on this one, but recover tax treatment, and then we'll just go through each one of these and make sure that we cover them. And while we're doing this, just throw out any questions that you can be thinking of, and we'll tackle them here in just a few minutes.
Yeah, so as far as tax treatment goes with the Roth IRA, it's after tax dollars going in, tax-free dollars coming out. As long as, and now I should preface that. If you're trying to pull money out before 59 and a half, like Christian mentioned earlier, you can access your basis, but you cannot touch the growth. If you do touch the growth, you're going to get penalized with a 10% penalty, and you pay taxes on it, everything like that. And so that's how taxes work there. As long as the withdrawals are qualified, then it's tax free coming out. As far as the life insurance goes, your premiums that you're putting into the life insurance policy have already been taxed. You're getting tax deferred growth as you go, and then you can access tax free dollars through policy loans within your insurance policy.
And I think it's also important to understand the reason that we're able to get tax-free money inside life insurance. So Brendan made a key distinction. He talked about the tax-free growth and then classified the tax-free access through policy loans. So if I take a distribution where I'm not loaning it, then the growth on that would be taxable. The way we're teaching people to use it is to never do anything other than take loans and flow our investment money in and out of the policy. And even when we get to that like later we like to call it phase two, where we start taking retirement income from it, we're just gonna change our methodology. At that point, we're gonna take loans until we hit our basis, which means it's not taxable, and then we're gonna take distributions till it's up to basis. Then we're gonna switch to loans, and we can take those out without ever having the intention of paying them back. And the reason we can do that is because we have this death benefit, which comes in and pays it off. So theoretically, let's say I've got a $3 million death benefit, and I've got a million eight in cash value, I could use all that cash value or the great majority of it, and the insurance company would say, okay, well, you have this $3 million death benefit, you have a loan of 1.8, we're going to pay off the 1.8 million, then the 1.2 goes to your family or heirs, right? So
Yep.
just trying, I probably got into the weeds too much on that, but did
We
I miss
do,
anything?
no, no, not on that. We do have a
Okay,
question. Do you want to tackle these as we go, some of these questions, or do you want to wait till the end?
let's see. What do we got here?
So
Let's
Lance
tackle it.
asks, yeah, yeah. So you mentioned bonus depreciation while talking about high cash value life insurance. His question is, how does bonus depreciation relate to high cash value life insurance?
The same way it does to any other money, right? So there's no direct coordination between the two. I'm just suggesting that I borrow the money from the policy. So I guess I shouldn't say there's no relation. In the way that we teach people to do this, all right? I build up the cash value, my opportunity fund. That's where I'm going to invest in things like real estate. I borrow against that. I'm leaving the tax basis on that the same. I'm also getting the compounding growth, even while the money's now being used for another investment, but I'm borrowing against that. And then I'm just getting it's just the exact same rules that I would have in any other situation. I could use that money and I would still get the depreciation, bonus depreciation. I could still do a cost seg analysis. Any of those things that I typically do with real estate, I can absolutely do those in coordination with my the policy that I'm taking a loan from. Hopefully that's
Yes.
helpful. Good question.
Yeah.
Good question. Okay, let's get to contribution limits. So this is obviously one of the biggest challenges when it comes to high income earners and using Roth IRAs. There's massive contribution limits, and maybe we'll talk about the income phase out kind of together. But from a contribution limit standpoint, if I'm making $700,000 and the most I can do is 7 or 8 grand, well, that's not going to move the needle. It's probably not going to help me. It's something, right? Well, actually, I said after I said that, I'm like, if you're making that much money, you can't contribute to it anyway. So the biggest constraint or challenge for high income earners is probably number one, the income phase out, which you can see there. Single 146 to 161. If you're married, you can do a little bit. You can make more and still use it. But if you're over that 240 number, then it's going to be hard unless you get creative and do things like the backdoor Roth, which can be valuable, but also have challenges because I still have to pay income at that future or at that point before I can make it tax free in the future, if that makes sense. So I still have to bring it out of the qualified plan in order to convert it. And that, you have to be careful making sure you don't increase go into the next tax bracket and create more tax problems than what you're actually creating in value. Okay, so those are some of the things. And then, of course, on life insurance, I don't have I shouldn't say that. I shouldn't say that. The only constraint I have is the amount of insurance that I qualify for. So just to kind of put it plainly so it'll be easy to understand, we typically don't run into people who have more cash than they're able to get in there. So if I'm $1 million earner, I could absolutely put $300,000 into a whole life policy, maximally funded whole life policy, and have no problem with that at all. I wouldn't run any income limits, and I would get the exact same tax treatment on that money that I would be getting with the Roth IRA. Can we move to the next slide, Kat?
While we're doing that, we have a quick question that I can tackle. Kaio asks,
Do
is
it.
it better to withdraw up to the basis, then borrow against cash value versus borrow against the cash value from the beginning? Which is a great question. So when we're utilizing the policy for wealth building, meaning we're putting money into the policy, we're taking loans against it to invest in alternative assets. As those assets produce cash flow, we flow that cash flow back into the life insurance policy to rebuild the policy so that we can repeat that process, right? If everyone's with me there, if you're utilizing it for that purpose, it's best to be taking loans in that example because when you take a loan, you see your life insurance policy, your cash value in your policy continues earning compounding interest like those dollars never left. So because that is what allows us to access or utilize our cash in two different places at the same time. When we take a loan, we can use it for a cash flowing asset. We also get that compounding growth in the policy. Whereas when you're taking income from the life insurance policy, so this is what we'd kind of describe as phase two. Phase one is the active investing phase. Phase two is the income phase of the policy. If you're pulling that money out purely as income, then it's best to withdraw your basis first. And then once you get to that growth in the policy, we switch that to taking loans to keep that money coming tax free.
Nailed it. Yeah, really good question. Glad you asked that. That's one that um, can kind of screw up your policy if you do it wrong. So you want to just make sure you're doing it right, so you're getting the maximum value from it. And to Brennan's point, once I get into that place where I have no intention to pay their loan back, then we'll talk about going taking the basis out. Okay, let's talk about liquidity, short-term liquidity. So I talked about this a little bit earlier, right? Sometimes it we suggest that there's no short-term liquidity with Roth IRAs, and I guess I shouldn't say there is. There is a 5-year rule, right? I can't just put it in and take it right back out. So I've got to wait the 5 years. But again, I do have access to the basis that I've been putting in. And so it's not that there's no short-term capital there, but it's more dependent upon obviously upon the rules that the IRS has put on it. And then meanwhile, on the life insurance side, one of the huge value adds, and maybe this is one of those things that, like, as I've kind of gone through my career and as I've gone through my own wealth building journey, I start to realize the value of control and flexibility and liquidity. And one of the things that high cash value life insurance shines in is the ability to do all of those things and really create like a multifaceted asset that is touching a lot of the things that I'm doing. And it just becomes one of those tools that I can manipulate in many different ways to create value. I'll give you an example. Let's just say theoretically I had a big liquidity event, and so I want to. Well, I'm trying to think of. Let's say theoretically I am in this retirement phase and I'm starting to take, a couple $100,000 a year from my qualified plans, and at the same time I have some sort of investment liquidity event, and now all of a sudden my income's potentially going to blow up. Well, I can press eject or press stop on the money that's coming out of qualified plans and instead go to the life insurance. And just by doing that, I'm manipulating the amount of tax that I end up paying. So one of the value propositions of life insurance is really that it is so flexible. And the irony here is that most people tend to think life insurance is not. And I'll talk about this too. The reason that high cash value life insurance, and again, I just can't emphasize that enough, because life insurance, if you took it at its bare bones, it does end up having a bunch of constraints. But at the moment that I start to fund it, this maximum funding that we're talking about, basically what I'm doing is I'm creating huge liquidity. I'm paying potentially 3, 4 premiums at one time, which now gives me the flexibility to not pay money for a period of time, pay more money. Like, I can just do a lot with it. So anyway, that's a value thing. Okay. I kind of got off on a tangent on that one. Risk exposure. So, did we talk about, oh, we didn't talk about investment flexibility. Okay. So
Yep.
this one's important. Actually, Brandon, why don't you take it? Go for it.
Yeah, so as far as investment flexibility, we mentioned that you can do a self-directed investment with a Roth IRA, and that provides a lot more flexibility. But typically, most people are using it just as being tied to the market. A lot of people have it in the S&P 500 or something like that, some index fund, and it's more of a set it and forget it tool for most people. I might say, I don't know what the percentage is, but a much smaller percentage of people are actually using it as a self-directed investment. But if you do that, that does open up the flexibility for a Roth IRA. As far as a high cash value life insurance policy, the returns that come from the insurance policy itself is tied to the performance of the insurance company. So, a mutual life insurance company with a whole life policy, you are a minority, almost a minority owner in the company. And so, because of that, as the company gets profits, they provide a dividend to their whole life insurance policy holders. And those are super consistent investments they're making. It's very transparent. You can go on any insurance company's website and see what they're investing in. And the companies that we're working with have been around, 100 plus years. They're A-rated, financially strong. So it's just something that is super consistent that you can count on, which is why it's so predictable and not market dependent, right? They were paying dividends through every financial hardship situation you can think of: Great Depression, high interest rates, '08 financial crisis. They paid consistent dividends through all of that. So, um, and then as far as taking it the next step with the life insurance policy, the high cash value policy, most people are not getting these high cash value life insurance policies because of the 5 to 6% return from the insurance company. Most people are getting this, yes, because they get that 5 to 6% while their money's sitting there, but they can also access that money to go out and invest in real wealth building opportunities like multifamily real estate, private credit funds, debt funds, self-storage units, anything like that. That's where they're going to get those major returns. And the nice thing is that your policy's cash value continues compounding uninterrupted, whether you have loans against it or not.
Yep. Well said. Okay. And maybe I'll just add really quick, since we don't have anything index universal life related on this slide. Um, we're like, okay, I shouldn't say we are product agnostic at the whole. Typically for the investment optimizer for the strategy that we're primarily describing, we use whole life for a couple of reasons. One of those reasons is because it's typically more liquid. It doesn't have any surrender charges associated with it, so I can access more early. Um, and then number two, like Brendan said, it's just ultra consistent. So we use Penn Mutual a lot. They have a history for 180 years, and it's been like from since, let's see, so we started using them in early 2000s, and they've consistently produced 5% plus returns, even through a really brutal interest rate time frame, right? So I look at it and I feel like, okay, if I look back in the 80s and 90s, we're getting, double digit returns even on our whole life policy. But even in difficult times, it's still outpacing a lot of like the bonds and things like that. And as far as the IUL side, you can absolutely use an IUL, but you have to be, just more conscientious of the actual investments that are inside the account. And then you have to make sure that there's not surrender charges associated with it. And there are a few companies out there who will offer an IUL that eliminates the surrender charge, but you do pay an additional cost for that. So again, you just have to make sure you understand the dynamics on that. Okay, we talked about short-term liquidity, risk exposure. That really just depends on the underlying investment inside of our Roth IRA. And when we come to high cash value life insurance, you could probably say the same thing. But inside the policy itself, again, when we're isolating that part, if we're talking about whole life, it's just ultra consistent. It's totally uncorrelated to market performance. If I have an IUL, I have a little bit more correlation, but I don't ever have direct exposure to. So regardless of whether I'm using whole life or index universal life, I don't have any direct market exposure. Okay, let's go to the next one. I think we have one more slide with a few more. Okay, tax diversification. I did touch on this a little bit, right? But both of them are powerful from a tax diversification standpoint because so many of us have been taught like put money in qualified plans. Like it's pretty rare that I meet a 52-year-old surgeon who hasn't put any money in the traditional qualified plans. Maybe it's a defined benefit plan or something like that, and they typically are putting a lot of money in. Well, Roth IRA and high cash value life insurance both end up being just a really powerful tax diversification tool because, again, just like I talked about in that probably poorly structured example from earlier, I am able to manipulate my actual level of income because the money that I take out of a Roth or that I take from high cash value life insurance using loans isn't counted on the books, and therefore it gives me the ability to create more flexibility. Anything you think I missed on that point, Brennan?
No, no, I think you hit it well. I think we moved to the
Okay, sounds good. So death benefit, that's pretty clear. Death benefit, I have a death benefit in the Roth, and it's just the value of the account. Obviously, in my policy, I'm certainly going to have a higher death benefit than what my cash value is. That's just the way that they're designed. Unless you live to be 120, there's going to be a fairly significant amount of additional insurance benefit that comes on top of it. But here's the thing that I also want to focus on there. Like when we talk about the 5 to 6% return we're getting inside the policy, that death benefit comes with that. It's not like it's being deducted. It's not like there's an additional cost. Like we're getting the 5 to 6% and the death benefit. So just think of it in those ways. Required minimum distributions. We don't have any required minimum distributions on the policy, we don't have any required minimum distributions on the Roth IRA, except that I do have to distribute. And when I inherit a Roth IRA, I have 10 years. There's no longer the ability to stretch them. That changed just in the last couple years. Got rid of the stretch IRAs. So it has to be a 10-year. So from an estate planning standpoint, there might be some differences. Cost structure. This one's. I'm gonna have you talk about the cost in the life insurance here in just a sec, Brennan. Um, Cost on the Roth IRA side probably doesn't make any sense. It's just whatever the underlying investments are. So if I'm using mutual funds, then I'm going to pay for whatever the cost of mutual funds is. If I'm using real estate, I'm going to pay the cost of whatever it took to get the real estate. So pretty simple, pretty straightforward. We'll take an extra minute to talk a little bit more about the cost on the insurance side, because this is one of those things that I think can be a little bit convoluted and difficult to understand. So we'll see if we can kind of pull back the curtain. Brennan, why don't you give it a try first, and then I can add to it if you miss anything.
Yeah, so maybe to start, I feel like one of the easiest ways to describe the cost of an insurance policy is first long term, and then I'll get more granular and how those actually come out, especially in the first few years. If you were to look at a policy 10 years in, 15 years in, 20 years in, at any point down that road, uh, you're going to see if assuming the dividend is averaging 6% per year, the internal rate of return is going to be sitting somewhere right around 5%, 5.1, 5.2%. And so the long-term cost, what it looks like is very similar to an investment account where you're seeing 80, 90, 100 basis points of cost is what the long-term effect is. Now, insurance companies front load the majority of those costs. So most of those costs are going to be front loaded. That's where you see, the heaviest costs coming in. And that's one of the biggest hurdles that people typically have when they're looking at high cash value life insurance. Because if somebody's putting in $100,000 a year into a life insurance policy like this, and what we're doing is we're structuring these policies very specifically to reduce the cost as much as we can, but they're still going to be there. And the three main costs in an insurance policy, maybe to hit that real quick, is number one, the cost of insurance, the cost of the death benefit that you're buying. Number two, administrative fees from the insurance company. And then finally, the commissions that get paid to the advisors or agents that set the life insurance policy up. Those are the three costs in an insurance policy. And what that looks like is year one, if somebody's putting in $100,000, they're going to get roughly 80% of that to hit their cash value, meaning 20,000 is not going to be there. That's going towards, again, insurance costs, admin costs, commissions, things like that. Year two, those costs are going to decrease, right? We're going to get more efficient immediately that second year. So when somebody puts in 100K the second year, just over 90% hits cash value and is available to use. And by the third year, it's going to feel just like a deposit into a bank account. You put in 100,000 shows up in cash value, and then you really start to see the compounding work in the policy. So those upfront costs, it's almost like setting up that policy with those upfront costs, but that's what gets us these really great benefits down the road and long term. But most of those are front loaded. Long term, again, it's going to look similar to an investment an investment account would look, with 80 to 100 basis points of actual cost.
Yeah, I think that's a good framework for it. That's the one that makes the most sense to me. I think about, here's what the insurance company is returning, here's what I'm capturing of that, therefore I'm paying this. So I kind of look at it and I say, okay, is 80 base or 1%, is a 1% cost worth it to get the life insurance policy with the cash value and the death benefit and all the value I'm getting? And for me, it ends up being kind of an easy no-brainer when I wrap my head around it that way. But I also understand. So if you're one of those people who's kind of been on the fence in this concept, and maybe the cost has been the biggest issue, I totally get it. The cost up front, right? Especially the fact that, like, there's no getting around that it hurts a little bit when I initially put money into it. But to Brennan's point, it does become more and more efficient to where you're 10 years down the line and you put 100 grand in it and 180,000 hits your account, right? Like, it's a different, as you go each year, it continues to be more and more efficient. So it's really powerful in that way, but it takes a little bit of patience. And so I think that's important to kind of remember. Okay, I was wrong. We have one more. Cat, keep us going. Okay. Contribution flexibility. We'll rock and roll through these and then we'll get to questions. Okay, contribution flexibility. Obviously, the Roth IRAs sets limits from the IRS. We've talked a little bit about that. The policy is totally flexible. On the income planning side, we've talked a lot about this, but or we've talked a little bit about it, but we'll hit on it more specifically. Obviously, in a Roth IRA, I've already paid the taxes. I pulled the money out. There's no tax implication. I do have to make sure that, like as we talked about, that on an inherited Roth IRA, I'm pulling money out. But aside from that, it's really flexible. Similarly, on the policy, I can do whatever I want with it. It just ends up being completely flexible. I can pull money out, on a yearly basis, just like I would out of any other account. I could pull it out when I need excess cash. I can really do it however fits and feels best for the situation that we're in. And here's kind of what I like when I was kind of trying to, you know, kind of tie this up in a bow. I feel like typically what we see when who's this ideal for? The Roth IRA is ideal for especially early investors wanting tax-free retirement growth and some flexibility, and they want to improve their overall tax situation. So a Roth IRA is incredibly powerful. And similarly, the cash value side of it ends up coming in as I get to a place where my income is higher and I'm phasing out of that kind of stuff. This ends up creating an opportunity to replace the ability that I would have had to put money in a Roth IRA with, I would argue, several additional benefits that I'm not getting there anyway. So when I look at it, like it would be nice to have I wouldn't mind having the ability to contribute to a Roth IRA, but I have this other tool, and in my world, it just is so much more effective at doing a lot of different things. Before we finish, potential weaknesses, we've hit on them. The Roth IRA just has the constraints that the IRS puts around them, the rules, the things we have to deal with from that standpoint. And on the life insurance, we've talked about it. The cost of the policy, that's the biggest weakness of the first year. And then the underwriting, that's no fun either, right? Got to go through underwriting to get it because there's a death benefit and the insurance company is on the hook. They want to make sure that they're working with people who they can afford to pay death claims on. Now, really quick, we oftentimes get asked about that about qualifying. Like the nice thing is from a qualification standpoint, because of again the way that we structure these policies, they're they're built for less death benefit. So it becomes easier for us to create and structure policies even if I'm a little bit older, even if I have some health challenges. Typically we can get it to where it's still producing a similar return to what we're talking about here. So if you're one of those people who's kind of on the fence for that reason, don't let that be the reason not to explore further. Okay, I think we got through everything, Brandon. Why don't we move over to questions? Do you want to lead us off in the question category?
Yeah, yep, I'll start. And I actually have a few from the chat. So do you want me to just go through the chat?
Yeah, do we have a Q&A and a chat?
I'm looking at the chat. I don't know if we have the Q&A up. Um,
Okay, I was just checking. I think we only have the chat. I actually don't see a Q&A
Great.
section. I'm not sure why. So anyway, we'll roll through the chat, but we have a bunch of questions or thoughts in there.
Okay, so Theo said, looks like most of the contribution is reaching the cash value of the policy. If we structure in a way where I contribute the bulk of the funds in the third year, can I save the cost?
Ah, yeah, I love it. I love it. I really do like the innovative thinking. Unfortunately, no. So here's how it works. If you remember, when we structure these policies, we create what we call a funding range, which just is a range of money that I can put into the policy. But really what it is it's two types of premium dollars that are going into the policy. And I'm going to specifically talk about whole life, even though the same principle applies for index universal life. So when I put money into it, I'm going to have two pots of money or two pots of premium. One is what we call base premium. This grows cash value in and by itself, but it also is where the cost comes from, right? And that base premium is going to be associated with whatever the death benefit is. So let's just say use $100,000 as an example. Let's say $20,000 is our base premium. That means that the other part of the premium is what we would call the paid up additions premium. That's where the most efficient dollars are going toward. So the challenge is in order to create that $80,000 of paid up addition value, I have to have the $20,000 base premium. So in other words, I can't create one without the other. Unfortunately, it doesn't really work, but I really love the ideas on how to think about it. Again, you just have to remember it's long term, and in the long term, in medium and long term, it's incredibly low cost. In the first year, it's high cost. So, but really great question.
Yeah, great question. Next question or comment. Oh, it looks like maybe I'll have you do this one too, Christian. Looks
Yeah.
like I didn't answer this question well enough because he said, Kaio said, still not clear on why to start withdrawing at stage two, taking income is more advantageous if you're assuming that the loan rate and credit rate is the same rate.
If you're assuming that the loan rate and the crediting rate are the same. Oh, okay. So you're saying when I get to that point, so most of it is tax efficiency, right? So you could theoretically do it either way. And I want to make that really clear. We're just talking about higher level of efficiency. So if I were to ask Brennan or Rod to run the illustrations, we might actually do a little bit better in terms of income producing out of the policy by setting it up in that specific way. We can potentially, because again, now I'm not creating any loan balance. And remember that I don't get that loan balance. Those numbers aren't exact until 10 years into the policy, I believe. Is that right,
Yeah.
Brandon?
Yeah, it's 10
I guess
years.
it depends on the policy, but with Penn, who we use most frequently, it's 10 years. We can get into more analysis on that one specifically. Typically, we teach people to do it that way, but as I think about it, if those two things are exactly the same, then you're theoretically right that there shouldn't be any significant difference. But anyway, we'll study that one a little bit further. Rod,
It
can
would,
you make a
I
note?
think at the end of the day, it would end up being really close. I think what we've done is just run the analysis and run the income both ways, and the income comes out a little bit better when we take the withdrawals and then switch to loans, whereas if we just start with loans. So, but
Yeah,
I think
that's what I'm
you
thinking
got
too,
it.
but I want to make sure that we get you a really clear answer on that. So we'll send you an email and make sure that we clear that up completely. Yeah, good
Yeah.
question.
Looks like Lance said, can I set up an annuity for savings slash growth intent within a Roth wrapper? Is this a strategy that conservative thinking savers employ?
Yes, it absolutely is. So you're saying, I think what I'm hearing you say is, can an annuity be a Roth? And the answer is yes. So let's say that I'm somebody that likes, a deferred income annuity or an indexed annuity or even a variable annuity. It doesn't really matter what it is. It can absolutely be connected to a Roth. Now, the challenge, of course, is making it Roth. Like, so you have to build up the account either way. But you could, let's say that I already had a Roth IRA that was, in the market and it was $250,000. I could absolutely go buy an annuity that is a Roth IRA annuity. Now, an annuity has its own tax benefits. It's not the same, right, as the Roth, but I can bring those together and basically the Roth IRA rules end up running the show there, if that makes sense. Similarly, you could have an annuity that's in a traditional IRA. Well, that's pretty typical. We see that in, like 403Bs with teachers and, states and things like that. So yeah, that's a good question. And if you want to get into more detail, we're happy to talk to you more about what that would look like. Okay,
Next,
Brennan, what's
next,
next?
yeah, next one is, and this might be more of a comment than anything, but for people who want a direct market exposure, they can still follow this route after tax money into the high cash value life insurance, take a loan into a brokerage account as long as the loan interest is neutral against the non-guaranteed dividend. And maybe I'll just comment on that. Yeah, yes, that works. And we actually, I would say that more often than not, the method that I see this happening is in crypto, because I just think that most of the people that we're working with, if they're wanting that market exposure, they just go directly to the market. However, something that's different is in the alternative asset space. That's where we see Bitcoin coming into play. And yes, there's no cash flow. There's nothing that's coming off the Bitcoin, maybe for a few years, even as long as they're not selling. And in that case, yeah, you're right. If there's no cash flow coming back in, as long as the loan interest is neutral against the dividend, then those are just growing together. And we have a lot of people that will even come out of pocket and pay the simple interest just to keep the interest simple. But there's certainly nothing that makes you pay that simple interest.
Libby says it was a great session. Libby, thank you. Thanks for hanging out with us for a little bit. Okay, do
Let's
we have any
see.
more questions we need to hit
Yeah,
on?
maybe one more. Where do you find most? Okay, so this was from Lance. This was a follow-up. What and where do you find most attractive investments for investing with loan money borrowed from your cash value, life insurance cash value?
Funny you should ask. Okay, so the best place to come is to check out our Investment Insider series. Join the Facebook group. So, our Facebook group is Investment Strategies for High Income Earners. We started what we're calling the IIS series, Investment Insider series. And the whole idea is to help people find access to places that they can invest their money. And so, we've done maybe 6 or 7 of them so far, something like that. And we're housing them inside of housing the webinars inside of our Facebook group. So if you join the Facebook group, you can have access to all of the past webinars, and that'll give you them. And then, as I mentioned, we're doing another one on the 28th, and we'll continue to um, provide exposure to different investment opportunities. Now, I want to be clear, we're not doing like deep dive on due diligence. We are learning about them, making sure they have a good reputation. Like we don't want to be, connected to any bad apples, but we're not getting into like the weeds on everything. We're not looking at the specific investments. So we're not saying, "Hey, you should do this." But what we are doing is saying, "Hey, these are people that we've learned something about that we feel like are at least worth exploring, looking for opportunities to invest." And the good news is there are so many operators now, and there's a lot of them that have a good track record. I think one of the benefits to come out of this last, the I guess, I don't know, the multifamily crash, for lack of a better word, that came about is that we started to kind of see who had a better idea of what they're doing and who don't. And now we can look back and say, okay, how did things go during those times? And especially if they've been able to manage those waters, you probably feel pretty good that they know what they're doing. So anyway, join the IIS list. Oh, I think we have a list for this. We do.
It's
Okay,
in the chat.
I'm Okay, it's in the chat, and also the QR code is on there. That's for the list. So basically, if you hit that QR code, we'll make sure that you get emails for all of the Investment Insider series that we're doing. And like I say, we'll probably have at least one a month, and so there should be consistently things going out. And like I mentioned, the one on October 28th is going to be on private credit with Jeff Ervick. Valoris Capital is the name. Okay, is there anything else?
Do we have time for one more?
Yep, let's take it.
All right, let's do one more. So Libby said, what are these 10-year figures from Penn Mutual that you guys are speaking of? Are there some specific numbers that we should be aware of, or are you just referring to the internal rate of return will be around 5% around 10 years in?
Yeah, thanks, Libby. I should have been probably a little bit more clear with that. So Penn Mutual uses what they call direct recognition, right? That just means that the loan rate and the crediting rate end up being the same. That said, there's a cost for the first 10 years that creates a 65 basis point difference, I believe.
Yep.
And so when I borrow, I have that little bit of cost that exists. So it's not like I'm just borrowing at zero for that. But once I get past the 10 years, I'm totally borrowing at zero because those the rates match completely, if that makes sense. So yes, good question. Hopefully that's helpful. And Libby, if it's not, then reach out to me and Rod, and we'll make sure that we cover it with you in more detail and give you a better understanding of it.
Yeah, and I
Hey,
just to that real quick. This is the reason why we always have our clients, paying that simple interest. Because as long as you keep the interest simple and you're earning compounding interest in the policy, even with that 65 basis point delta the first 10 years, you're going to have an added layer of profitability because of your policy. So even if the interest rate you're paying is 5.3% and you're earning 4.65%, that 4.65 is compounding, the 5.3% is simple, and over 3 years, 5 years, 8 years, 10 years, however long you have the loan out, you're going to experience that added layer of profitability simply because the simple versus compounding interest. It just gets a little better at the 10th year. It can get even better if we can get a cash value line of credit to drop below, a 5% rate. And so again, like Christian said, if you have other questions, happy to chat more, set up a strategy call. I'm happy to talk through any of this with you. And we can just go from there.
Awesome. Okay, hopefully this was fun. Love to hear feedback. If you guys liked it, didn't like it, shoot us a message. Appreciate everybody hanging out with us for today, and we'll see you hopefully at the IIS event on the 28th. Thanks again.